Most people think the biggest risk in retirement is a market crash. Well, it isn't. The real risk is when that crash happens. And if you're retiring or might be forced to retire earlier than planned, the timing can quietly destroy an otherwise solid plan. This is called sequence of returns risk, and it is the one risk I'm spending the most time thinking about right now. When you're accumulating, market returns can come in any order. Bad years, good years, it doesn't really matter because you're still adding money. But once you start taking money out, the order suddenly matters a lot. Two portfolios with the same average return can end up in very different places, simply because one had bad years early and the other didn't. That difference is what catches people off guard. Imagine two people retiring on the same day. Both have $1 million US. Both invest in the same global portfolio. Both plan to withdraw 40,000 per year. Over the next 20 years, the market delivers the same average return for both of them. The only difference is when the good and bad years happen. Person A retires into a bad market. In year one, the market falls by 20%. The portfolio drops to 800,000. They still need their 40,000, so they sell at low prices, which puts the portfolio at 760,000. Year two is another bad year. The market falls another 10%. The portfolio drops to 684,000. They sell another 40,000, which puts the portfolio now at 644,000. So over 30% lower from where they started. Even if the market recovers strongly after that, they're now compounding from a much smaller base. Their portfolio never truly recovers. Let's now look at person B, who retires into a good market as comparison. In year one, the market rises by 20%. The portfolio grows to 1,200,000. They take their 40,000 in living expenses. The portfolio is now at 1,160,000. Year two is another good year, and the stock market rises another 10%. The portfolio grows to 1,276,000. Again, they withdraw 40,000, which puts the portfolio now at 1,236,000. So up over 20% from where they started. Now, even if markets fall later, they're falling from a much higher base. So 20 years later, both had the same investments, the same average returns, and the same withdrawals. Yet, person A may run out of money, person B still has a large portfolio. Not because they invested differently, but because bad years came first. That is sequence of returns risk. It's why how you get your returns matters just as much as how much returns you get. When you're accumulating, market drops are annoying but harmless in many cases. You're not touching your portfolio. Time heals everything. But in retirement, every sale is permanent. You're not just down on paper. You're literally removing future compounding power. And this is where income assets change the game. Dividends and bonds create a withdrawal firewall. If all your money is in growth assets, you must sell shares, even in crashes. But if part of your portfolio pays income, like, for example, bonds, dividend ETFs, income funds, cash buffers, or property income, you can fund most or all of your spending without selling growth assets at low prices. Your growth assets get time to recover. Your retirement becomes shock absorbed. That firewall is what keeps sequence risk from killing your plan. That's why it makes sense to adjust your portfolio when retirement approaches. In your 40s, growth maximization makes sense. In your 50s, you start building your income engine. In retirement, your portfolio's job is no longer maximum return. Its job is stable cash flow, low forced selling, emotional survivability, and market crash tolerance. That's why your strategy, moving from growth heavy to global income ETFs, isn't giving up returns. It's buying retirement stability. The simple mental shift: growth investing asks, how big can my portfolio get? While retirement investing asks, how reliably can my portfolio pay me without breaking? And those are completely different problems. This risk becomes much more serious if your retirement isn't fully voluntary. If you lose a job earlier than expected or can't find a comparable one, your portfolio suddenly becomes your income source whether you planned for it or not. That's why I'm thinking about this now, not at 65. Because once withdrawals start, the first years matter more than almost anything. A lot of retirement advice still focuses on long-term average returns, but averages don't pay the bills. Cash flow does. If your plan assumes you'll always be able to sell assets at reasonable prices, it's more fragile than it looks. Sequence of returns risk is really about fragility, how easily a plan breaks under stress. For me, managing this risk isn't about predicting markets, it's about design. I'm trying to build a portfolio and lifestyle that reduces forced selling, especially in the early years. That means a mix of income, cash buffers, and flexibility. Not because I expect the worst, but because I don't want a few bad years to derail everything. This is also why the portfolio mix often changes as retirement gets closer, not because bonds or income assets are exciting, but because they can buy you time. Time to wait out bad markets, time to avoid selling at lows, time to make better decisions. That time buffer is incredibly valuable, even if it slightly reduces long-term returns. The good news is that this risk is manageable. You don't need perfect timing, you don't need to predict crashes. You just need a plan that accepts uncertainty and gives you options when things don't go your way. That's what I'm working towards. In the next video, I'll show how this thinking translates into real portfolio decisions, income, bonds, cash, and partial drawdown, without turning it into a spreadsheet exercise. If you're approaching retirement and want to think about this clearly rather than fearfully, consider subscribing. Have a wonderful day and see you in the next video.